A very good morning, folks, and welcome to a brand new episode of the FinMet Mondays podcast. Thank you so much for continuously tuning in. Neil, last week, I believe you'd attended the Asia Pacific Precious Metals Conference. A lot of talk about bullion, gold, and silver both. Can you briefly tell us about what were the details of that conference, what was discussed, and what was the mood like among investors?
Firstly, it was a very well attended conference, over 500, 550 participants from across Asia and also from Europe and US. Three themes came through in talking to people. Three things stood out. Firstly, talking to the participants from China and even people who supply to China, everyone confirmed that this month of May, demand was really low. And they are seeing a slowdown. The central bank, as we mentioned last time, has also announced that they didn't do any purchases in May. So overall, the volume of imports also was probably the lowest in May compared to the rest of the year, and that probably gives you an indication of why the prices came off. Also, in talking to some of the big suppliers to the retail coin market in the West, in Germany and in the US, everyone said that demand this year is dramatically down. They had lots of stocks. The mints who were working at 100% capacity last year are now at a much lower capacity utilization, less than 50%. The ETF holdings of yesterday actually are about 825 tons. We touched that level briefly in March. So it's been coming down from 1,000 tons down to 825. We briefly touched 820, 25 levels in March. But before that, the last time we saw these low levels was in 2019, March of 2019. So almost 5 years ago. So why, over the COVID period, all the purchases on the ETFs that took place have all been sold now, and I think that shows that the mood, at least in the West, from the retail investors, is very is one where they can take profits. They feel that these prices are too high. Maybe they'll come in when the prices go lower, but right now they're in a selling kind of mood. And also talking to people, the mining establishment, their all-in cost is around 1800 dollars. So for them, the current levels of 2200, 2300 are very, very good. And so from what it shows me is that maybe they can sustain a lower price. So even if there's some selling or there's some hedging, they'll be fine with lower prices. So I mean, not fine with lower prices, but they will be able to still make money at lower prices. Overall, the mood I got was a little bit bearish, showing that the maybe gold has gone up too high, and we need to see a little bit of a correction before we see further buying coming in. For silver, it was a feeling that the hike up of silver, maybe because of demand from China, was overdone, and they expect that in the coming months, the demand from China from solar panels will not be as high as it was over the last year or so.
Interesting. So I think you explained, Sunil, about why in the West demand has dropped considerably. But what is the reason demand has dropped in China specifically? Suddenly, is this just a response to the sudden surge in prices that we saw in March? So this is a period of consolidation. Are there other external factors at play that are also contributing to this ebb in demand?
Yeah, I think at the beginning of the year, demand was incredible. So there's a little bit of a leveling off or averaging that's taking place. So people bought a lot and saw the gold price going up, right? And so there's a little bit of profit taking that's taking place.
Hmm.
So it seems to be that they're slowing off. Mr. David Tate of the World Gold Council mentioned that the view of the council is that the Chinese investors are actually pausing and maybe taking a breath and taking profits because they've been buying all the way from 1800 to 2300. Some of the other asset groups like equities, bonds are doing a little bit better than they were earlier. So maybe there's a little bit more diversion of capital from gold into those traditional markets.
Understood. Understood. What didn't help metals either was Fed's interest rate and dot plot projections this last week. From three interest rate cuts that was previously projected, it was reduced to one. And although a lot of investors called it as a stale forecast, it definitely will have a bearing on how gold's price. Let's look at what the outlook looks like for next week. Markets were able to pick up from the lows of 2295, and they've been able to station themselves around 2330, right? That was the trajectory for last week. The supporting elements maybe that would dictate the price outlook for next week are a couple of things. A, we can see that there is double bottom support right here and right here as well. And that is going to be a strong area of buying. We've seen this already in the past. Secondly, there is an ascending trend line that is drawn from the Feb low as well. This is another ascending trend line that will be looked at by technical buyers as a point of entry.
So 20 to 80 is the
20
kind
to
of
20 to
level.
80, 20 to 80 is that kind of level.
Okay.
Interesting. What was also interesting, and this was something I had pointed out in the market watch as well, that you had seen a head and shoulders being formed pattern. So this is the head essentially, and you had seen a shoulder pattern here and a shoulder pattern here. So this head and shoulder pattern is typically a bearish pattern that indicates that we're in a slightly medium term bearish downtrend. Although to confirm this same 20 to 80 support needs to be broken. So we're still not sure of whether we're in a bearish downtrend or not. The levels that are supposed to be broken are still holding currently. For US spot silver, it's pretty similar, although there's a little bit more runway for silver. We did see silver break that 29 level, and now the next support is around 28. The other thing to note is there are two exponential moving average lines, which is the 9 and the 20 moving average. The 9 is the orange and the red one is the 20. For majority of the last 3 months, you've seen the orange line trade above the red line, and you're slightly seeing this gap reduce to almost a very small figure. In the past, when we've seen that when this orange line has broken below the red line, there has been a period of volatile trading in a very narrow range or even a bearish movement. This is something to watch out for silver, that it does have some runway to be able to sustain the bearish pressure. But if you start seeing this crossover, that 28.05 support is going to be tested. Thanks, Sunil. Thank you for the detailed inputs from China and from all the developments from the conference. Let's look forward to what's going to happen next week. But till then, thank you so much and goodbye.